Hello everyone, I'm Subhas Karki. My student ID is OED2936. As a part of assessment, corporate accounting was on 5020. Income tax fraud accounting was the topic of our individual assignment, and in this video, I'll try to summarize the whole assignment in the duration of 10 minutes. So, the purpose of the report is to focus on the different concepts that makes up the field of income tax for accounting and understand differences between the concept and computation that are done in income tax accounting. The purpose is better solved through the study of 2019 annual report of JB Hi-Fi, which provides a context and helps to apply the concept of income tax accounting to an actual set of financial statements. So, in this video, I will summarize the concept of accounting profit, taxable profit, temporary differences, taxable differences, deductible temporary differences, deferred tax assets, deferred tax liability with examples. Similarly, I will be explaining the criteria of deferred tax assets and deferred tax liability in the case of JVIP. Likewise, I will be briefly summarize the tax expenses as reported in annual report of JVIP of 2019. Then I will explain why the tax expenses as per the latest financial statement does not match with the tax rate times at the accounting income. Similarly, deferred tax assets and liabilities that are reported in the balance sheet, articulating the possible reasons will be explained, and there are I will try to examine whether or not there are any current tax assets for income tax payable recorded by the company or not, and I will also explain the income tax payable, how the income tax payable is not same as income tax expenses. So now let's begin with the concept of accounting profit, taxable profit, temporary differences, deductible temporary differences, deferred tax assets, and deferred tax liability. Accounting profit is the profit including any amount of profit which is called as accounting loss, that is derived from deducting cost from revenue, revenue when both costs are as well as the revenues are accounted for in financial statement. Similarly, taxable profit, while accounting profit is reported profit that gets reported in annual report, taxable profit is different. Taxable profit refers to the amount of profit that becomes the base for the computation of taxes. So, research expenses are recognized as accrual basis. Similarly, taxes deductible for the taxation purpose, it is deducted in the year when actually paid. Similarly, goodwill impairment is recognized on accrual basis, and its tax payment in tax treatment is not allowed as a deduction. Now I will explain taxable differences. Determine the timing of recognition of revenue and expenses. Accounting principle and taxation rules are considered with each other. This consistency causes temporary differences. Then deductible temporary differences means that a temporary difference that exists because expenses were recorded in a certain year that is considered as expenses for the year by the tax law and therefore allowed to deduct while filing taxes but not considered as expenses. Deferred tax assets are potential future savings. Deferred tax liability is the positive amount of difference created when tax expense computed on the basis of accounted profit is more than tax liability computed on the basis of taxable profit. Now I will summarize the recognition criteria of deferred tax assets and deferred tax liability in case of JVIFI. The company's 2019 report has several notes to the financial statement, and to the financial statement, note 6 pertains to recognition and measurement of taxes. As for deferred tax, the company practiced to measure the deferred taxes at the rate expected to force in the period in which excess is to really realize and or liability is to be settled based on the taxes. Deferred tax assets and deferred tax liabilities are recognized in case of business combination if the temporary difference occurs due to initial recognition. However, in case of other than business combination, deferred tax assets get recognized only extend to probability future taxable profit. To extent that the tax benefit will probably go unrealized. There is a reduction of deferred tax assets. Annual report 2019 of JVIFI show no specific recognition criteria for deferred tax liabilities is mentioned. Now that company's tax expenses as reported in its 2019 annual report. As per the company's 2019 annual report, the income tax expenses as per the statement of profit for the loss of financial year June 2019 is 109.5 million. So why that the tax expenses as per the latest financial statement doesn't match with the tax rate time with the accounting income? The total income tax expenses of the current accounting year as reflecting in the statement profit or loss is made up of expenses computed in the relation of current tax liability and tax expenses computed for movement and deferred tax Now I'll explain the temporary difference attributes to deferred tax assets in 2018 and 2019. In 2019, the provision was 42.6, while in 2018 it was 35.6. Inventories were 9.6 million in 2019 and it was like 8.1 in 2018. Similarly, deferred revenue was 40.7 million in 2019, but it was 45 in 2018. So total deferred taxes in 2008 deferred tax assets in 2019 was 106.5 million, while it was 99.4 in 2018. So brand names was now I'll explain why the income tax payable is not same as income tax expenses. The 2019 annual report provides a reconciliation between income tax payment and income tax expenses. The reconciliation makes clear that the reason led to differences in amount for income tax payable and income tax expenses. Now I will be explaining an identification of any permanent differences that the company could have. Permanent differences can exist when there are some revenues that are never taxed and some expenses that are never allowed to deduction. The 2000 annual report of JVIP has provided items of income and expenses in the statement of profit or loss and has also provided note to the financial statement. However, the information made available does not indicate that any permanent differences exist in JVIP in 2019. Similarly, so I will be explaining a new site gained from explanation of firm's tax expenses as how companies account for income taxes. The annual report of JVIP 2019 has provided a good degree of clarity on how income tax expenses are computed and what the component of income tax expenses are. For the annual report provides a reconciliation of income tax expenses with income tax payable. This helps to get a better insight into how the temporary differences and differing rates of tax applicable to the company overseas subsidiaries can lead to difference between companies' income tax expenses and tax payable. This insight were gained through understanding the various concepts falling under the topic of income tax accounting and applying this concept to the real world financial statement of a company listed on EXS. So finally, I have concluded that income tax expenses can be a complicated topic to understand if one is unaware of the differences between permanent and temporary differences and is unable to understand how cash basis differs from accrual basis. Furthermore, it is imperative to understand the differences between terms such as income tax expenses, income tax liability, income tax paid. It is difference between income expense, income tax payable, income tax paid. It is important to understand how income tax expenses is computed when compared with income tax payable is computed. The 2019 annual report of JV Hi-Fi has provided a great deal of disclosure, including reconciliation and explanation to help throw light on how companies account for income taxes and report the same in financial statement. Okay, thank you everybody.